Vanguard is held in high regard amongst investors, and this is largely due to their low costs and simple approach to investing. Whatever your investing goals are, unless they're extremely niche or focused on a specific company, Vanguard will probably have an index fund for it. From their LifeStrategy funds to their target retirement funds to ETFs, there are a lot of options to choose from, and it can get quite confusing. If you're new to index funds or to Vanguard, let me break down and simplify each category of fund that they offer. I'll give you some example funds in each category and roughly how much it will cost you to invest into it. Fees can vary slightly between funds, and it's often cheaper to invest into Vanguard's funds by not using Vanguard at all. I'll explain more on that later in the video. Before we get started, please note that none of the examples included in this video are investment recommendations, and your capital is always at risk when investing. We'll start with the bedrock of Vanguard's platform, their stock market focused index funds, and these come in two forms: mutual funds and exchange traded funds, or ETFs. Understanding this part will help you understand the rest of their funds later on, even though they work very differently. To briefly explain, an index is another word for a list, and a fund is a pool of money that invests into something, or in this case, a list of businesses. ETFs are traded on the stock exchange and can be traded throughout the day, whereas mutual funds are traded once per day at a set price. The index fund was actually introduced to retail investors by Vanguard's founder, John Jack Bogle, when he created the Vanguard 500 index in the mid-70s, so they're kind of known as the index fund platform. You'll notice that all these index funds have very different names, and that's because they all track and invest into a different list of businesses. I'll link a separate video in the description that helps you understand what all of these names mean. In short, some index funds might invest into the 500 largest companies in the US all at once, whereas others will invest into companies from the UK, Japan, and loads of other places. You can even cover the entire world. Index funds give you the opportunity to invest into an entire market rather than cherry-picking individual stocks. This type of fund typically comes with low ongoing costs. For example, Vanguard's S&P 500 ETF charges you 0.07% of your investment every year at the time of recording, which is about as low as you're going to get in this area of investing, and significantly lower than we'll see with some funds later on. Vanguard's S&P 500 ETF is a good example of one of the funds they offer, and as I referenced before, this fund tracks the 500 largest companies in the US, so your Apples, Microsofts, Teslas, the big boys. And the index it tracks will be automatically updated every quarter, so you won't have to worry about the list becoming outdated or significantly skewed if one company booms or busts in share price. An example of another index fund that Vanguard offers is their FTSE Global All Cap Index Fund, which tracks just over 7,000 companies of all sizes across the entire world. It has a higher ongoing charge than the S&P 500 ETF, as you'll pay 0.23% of your investment every year, but it's still considered to be pretty low. Investing into more businesses and without the reliance of just one country gives you more diversification. That's not to say it will perform better, but it's considered to be slightly lower risk. Again, your capital is always at risk when investing though. The equity-focused index funds, that is, the index funds made up of stocks and shares, is usually popular with passive investors that don't want to actively choose all of their investments, and would rather invest, say, once a month into an entire market instead. They're happy to take on higher risk levels in the equity market, again that's a fancy word for stocks and shares, because they have a very long-term horizon, say 20 plus years, and they're comfortable accepting the higher level of risk in exchange for a higher potential return. Next, we'll look at Vanguard's LifeStrategy funds, which offer a ready-made investment portfolio that is a popular choice for investors as a set-and-forget investment. If you're not looking to actively manage your own portfolio, even if it just contains passive investments within it, then this might be an option to look at. The LifeStrategy fund gives you 5 choices in total based on the amount of risk you're willing and able to take. Each of these options differ based on their equity and bond split. Stocks typically yield a higher average return long term, but they come with more risk. For example, if the stock market crashes, your investment will suffer as a result. So if you have time on your side and you're able to ride out those short-term crashes over the long term, a higher percentage of equities might be for you. Whereas bonds are considered to be more low-risk securities, as you're essentially loaning money to governments and companies. But they do typically yield lower returns as well. And they still can crash in price. So these LifeStrategy funds are a mix of bonds and equities at varying different splits, as you can see here. These funds invest into thousands of businesses from all across the globe, with a heavier weighting towards UK companies, which some people like, but others might not due to the UK not really making up much of the global market cap. What this does offer though is still a diverse investment portfolio where you don't have to manually pick and choose yourself, hence why it's a popular set and forget option for passive investors. All of Vanguard's LifeStrategy funds at the time of recording will charge you a 0.22% ongoing fee every single year. Those with high risk tolerances and very long-term investing timelines would generally favour a higher equity focus, and then those with low risk tolerances or a shorter term investing timeline might favour a higher focus on bonds. But there are no set rules, especially when it's your money at risk. Somewhat similar to Vanguard's LifeStrategy funds are their target retirement funds, but they do differ in quite a notable way. As the name suggests, these funds are designed to help you save for retirement, but unlike their LifeStrategy funds where you choose the amount of risk you want to take based on your investing circumstances, target retirement funds are dynamic, meaning as you close in on retirement, your portfolio will automatically start investing less into shares and more into bonds in an attempt to minimize risk. And that's why each of these funds have a target retirement date set on them. So currently it goes all the way up to 2065 in 5-year increments, and as you'll notice, the longer you have to invest before you retire, the heavier the portfolio will be towards equities. These funds are even more of a set and forget option than LifeStrategy funds, as you can simply invest your money as often as you'd like, and let the fund invest for you and update the portfolio as you get older. You will pay a slightly higher fee for this service though, as the fund managers will update the holdings as time progresses, but it's nothing too drastic, with the target retirement funds charging you a 0.24% fee each year, regardless of which target retirement fund you invest into. So really, you're still getting the same passive investment into a list of businesses and or bonds, but it will be tailored for you to brace for retirement. And if you're happy to pay a little extra for this service, then target retirement funds offer an extremely simple way to invest for your future. And let's be honest, a 0.24% annual fee isn't that much, on its own at least. But remember, we are going to talk a bit about Vanguard's fees shortly, because it's often cheaper to invest into Vanguard's funds elsewhere. All of the funds we've looked at so far have been passively managed. Now we'll take a look at Vanguard's actively managed funds, which instead of tracking these indexes, will try to outperform them by picking and choosing individual stocks and bonds for you. These funds will have designated fund managers that will constantly be researching and regularly updating the portfolio to try and achieve greater results. This means that actively managed funds are often more expensive than passive funds. For example, Vanguard's Global Equity Fund has an expense ratio of 0.48% per year, which is double that of their target retirement funds and far more than some of their ETFs. Seeing as you're not just tracking the market's performance though, you're actively trying to beat it, these funds also come with more risk, as you're leaving your portfolio's performance up to the choices made by the fund manager, and sometimes they can mess up. In fact, they rarely beat the performance of a passive fund, but that's probably a topic for another video. Vanguard offers a wide range of actively managed funds, from their Global Equity Fund that invests into companies from all across the globe, to their Global Credit Bond Fund. You also have the option, much like with their passively managed funds, to invest into different geographical regions, like their Active UK Equity Fund or their Emerging Markets Bond Fund, and you can filter all of their funds by either passive or active management here. If you're willing to take on more investment risk in the hope of higher returns, then these actively managed funds could offer you the chance to do that. But like I said, you will pay a higher fee for this, and there is no guarantee that the fund will outperform the market. Some investors like to be conscious of what they're investing into and take a more ethical approach to investing, with the general logic being, why would I invest for my future if I don't see one happening? Vanguard has select funds for this type of approach as well, called their ESG funds, or Environmental, Social and Governance. So if you want your investments to be in line with your personal values, you can look for ESG in the fund name, like their ESG Global All Cap ETF. Or it doesn't have to have ESG explicitly stated. You could look for things like sustainable, or just research the fund's holdings to see what the approach is. ESG funds allow you to only invest into companies that take a more moral approach to business, and this could be through paying their employees fairly, having a low carbon footprint, producing eco-friendly products, and so on. Due to ESG being an umbrella category for all sorts of investments, you'll find that the fees you'll pay do vary quite a bit, usually sitting between 0.1 to 0.3% for the most part. But if you were to invest into one of their actively managed ESG funds, like the Active Life Climate Aware range, you would pay a higher fee of closer to 0.5% a year. It's worth noting that different funds can have different definitions of what ethical means, so if this is important to you, you will need to do some digging into what companies are being invested into. We've spoken about bonds earlier in the video, but to briefly cover Vanguard's range of bond funds, you can find passively managed or actively managed funds on Vanguard's platform that will only invest into bonds. These funds are considered to be lower risk and are usually used by investors to hold a portion of liquid cash in, so that it's more easily available to them in the short term, while still generating some returns on it. Much like the ESG funds, because there are a wide range of different types of bonds that you can invest into, these funds don't have a specific ongoing fee, but can range from around 0.05% to 0.25% a year. Unless you're investing into an actively managed fund, then it can be much higher, around 0.6%, but still generally cheaper than funds that focus on shares. On all of Vanguard's products, you'll be able to see what percentage of the fund is shares and what percentage is bonds. So if you're trying to curb investment risk and only want a short-term investment, you can check here to see exactly what you're investing into. But bonds do also have risk and can decrease in price. The volatility has just been far less volatile over a long period. Finally, on most funds that are available with Vanguard, you have the option to either choose accumulation or income. And there is a big difference between the two, so you'll want to know this before investing. If you choose accumulation, the fund will automatically reinvest any dividends you may receive back into the fund, with the aim of growing the investment as much as possible through compound interest over time. Whereas if you choose income, if you receive any dividends from your investment, they'll be paid out to you either monthly, quarterly, every 6 months, or sometimes once a year, and then you can either take that money as additional income, or you can choose where to reinvest it, rather than it going straight back into the same fund. It's important to make sure you're investing into the right version of the fund depending on how you'd like to receive your dividends, so before anything else, you can select the option you'd like by using these options here. But just know that if you choose an accumulation fund, you won't see how much you've earned from dividends because they never come back to you. They go straight back into the fund rather than being dished out and put back in again. I mentioned at the start of the video that it can sometimes be cheaper to buy Vanguard funds on other platforms, and surprisingly, this is quite a common occurrence. Vanguard themselves have never claimed to be the cheapest broker on the market, but more that they offer simple, low-cost investing. With that said, due to their yearly platform fee of 0.15% capped at £375, investing into Vanguard issued funds through Vanguard's platform isn't actually the cheapest way to do it. And this is further emphasised by their £4 minimum monthly fee, which applies to anyone with a portfolio of less than £32,000. If you're only investing £100 per month, you'd effectively be paying 4% in fees to Vanguard, plus their fund management fees, which are separate, which is absolutely massive and actually means you have to generate a really significant return each year just to break even on your deposits. Now, you can't avoid Vanguard's fund management fees, but you can avoid their platform fees. And because they're so popular, many of Vanguard's funds are available via other brokers and investing platforms as well. And some of the other options don't charge an account fee or take any trading commissions. Their ETF range is available with plenty of other investment platforms, Trading 212, InvestEngine, Lightyear, XTB, and more, all of which charge less in fees than Vanguard does. But not all of these platforms provide mutual funds. That's okay though. You can also invest into Vanguard's mutual funds, LifeStrategy funds, and target retirement funds for less elsewhere. But this will depend on your portfolio size and some fee caps. If you have a large balance, flat fee options like free trade or interactive investor can end up being cheaper. We've got a free tool that's pretty good at comparing fees when investing in index funds, so I'll link that down below.